So thank you guys for being here, being on time. And Kirk showed up fashionably late about a half hour ago, thinking that we were starting at 6. So yes, this is going to be an intimate setup. You know, if you guys want to interject, have a discussion, this is not a totally formal scene. So, hey, Debbie.
Hi.
So just to rehash some of the, investing 101. Why is investing in real estate a good idea? You don't have any thoughts?
I don't know why it's good. It seemed good at the time.
Right. Well, first, you were bamboozled into investing. Right? So first off, you can create wealth, right? Create wealth through amortization and appreciation. So your chart here, let's say you buy a house with 0 down, $200,000. It's going to slowly appreciate in value over time. At least that's been historical trends. And you're going to pay off the debt over time. And that spread, that difference, is equity, right? That's what everyone's chasing after, is that equity and wealth. So that just happens naturally over time if you own real estate and you pay your debts. So there's tax benefits to real estate. You can write off what? You can write off depreciation. What's the depreciation rate on real estate that you own? It's 27.5 years straight line depreciation, right? So take the purchase price, divide it by 27.5, and that's your annual amount you need to write off on your taxes.
Question for you. Can you do cost segregation on residential real estate?
You can.
Or just commercial?
You can do cost segregation. That's usually something you want to do for like larger units, larger scale. You can depreciate some things faster. So anyone know what cost segregation is? No? Okay. So just real quick, you can take certain aspects of your portfolio and say, okay, well this part of the portfolio is depreciating faster and I'll write that off more this year than another part. Like let's say the carpets or the mechanical features. You kind of break the real estate up into pieces of the parts and say these parts are depreciating at a certain rate. And so you use that if you have a really good year income-wise, it might make sense to do that. But typically you want to have a lot of units to do that. It doesn't make sense for 1 or 2 units typically.
What about raw land or farmland? Can you appreciate that, or does it have to be have a structure?
So if it's an income property, like if you're renting it out for agriculture or leasing it out, I believe you can. I don't believe it has to be an approved lease, but
What about recreational property that's bought for investment?
That's
depreciated.
if it's an investment property. If it's personal use, no. But if it's an investment, yes. Welcome, latecomers.
Sorry about
Right over
that.
there. This would be like the 3 old guys in the Muppets in the back row. Like in the back.
Unless it's not feeling well. So
Yeah, okay.
Unless something's
Real estate makes me sick too. So you can also write off your rental expenses, any improvements or capital expenses in the property, those are depreciable. 1 year I had back when the lending was fast and loose, and they were you could fog a mirror and check the pulse and get a property. I bought a giant property, like a $210,000 property, and then I borrowed another $50,000 and dumped the $50,000 into the property. Well, my accountant about gagged when he was doing my taxes the next year because I wrote off that $50,000 as an expense, and that was basically more than I'd earned in regular income, for the year. And so he's like, whoa, I had some hesitation on how we structured that write-off. But anyway, lots of benefits. So the real holy grail of investment is the cash flow and looking towards the longer picture, right? Trying to provide passive income for retirement and improving your standard of living. So in a previous presentation, which we might redo in January, I showed folks how you could take $55,000 today and turn that into $55 $75,000 a year through investing. We do that in a 15-year time frame. So that's a whole separate 2-hour presentation, and we'll do that later. But so finally, real estate as an investment is pretty stable relative to other instruments. And here we have, and I don't know if you can see these charts very well, but here you have Weber County house values. Right? This is based on the red line is the housing price index coming from the feds for the Weber County market. You can see going back to 1979, it kind of is a little plateau, a little wavy. Then we have a surge in the 90s, a little plateau, and then we have this camel hump. Want to guess what that is? So we have the camel hump, and then we have prices tracking back up again. And then down below, I have the Dow for the same period of time, and it's a little light. You can't really see it, but it's really wavy, really choppy, and still increased over that period of time, but it's not been a straight line per se.
Are we back to parity pre-2008 levels?
I'm glad you asked that question. Those are our next charts.
All right.
So where are we at? Where have we been? Let's take a look. Sales activity, first off. Sales activity is an indicator of the health of the market, right? How confident are people in the market? How easy is it to transact? Here we have the slow progression. This is going back. This is MLS data, right? So this is pulled this right off the MLS, crunch the numbers, and then put a trend line through it so you can kind of take out the seasonality aspect. But you come up into 2006, 2007, those 2 peak years, and then 2008 was a real bad year. 2009 and 10. I mean, basically the market flatlined right here for the last half of 2010. I still have scars you can see from that experience. You can still see my ribs. But after that point, 2011, things started to come back. Lending had a lot to do with this factor and consumer confidence. But now we've trended back up. So if you look back, and we're back to 2005, 2006 sales activity, right? And also keep in mind that the difference between then and now was that then, to get a loan or to transact, you just had to have a pulse, right? Anybody can transact. People that are transacting today actually have some wherewithal as buyers to do so.
Jeremy? Is that volume by dollars or number of transactions?
That is a transaction count. So this is the number of homes sold in Weber County. So you can see they peaked out at 520-ish was our peak, very top, total melt up number, and then we went back down to during our summer months we were selling less than 200. That's like famine and land type numbers, if you're in real estate business. And then so now we're back to, we're above 400. Keeping in mind that the population of Weber County has increased this whole time, right? And so there should be an upward trend. Okay, here we are, median sold price, right? Median. We are now past our peak in the previous bubble. Again, the difference. Back then, you didn't need any real qualifications. Just show up and sign some paperwork and you can get a loan. Today, not so much, right? More rigorous guidelines. So the price points, I look at this chart and I'm like, ooh, I get nervous, right? And my initial impulse is to get nervous because I still have twitching that occurs when I think about what happened after 2007. But now, underwriting guidelines are more traditional. We're using the fundamental laws of economics to dictate what a person can afford to borrow to buy a home, and that's driving house prices. And so, Weber County home sales based on price per square foot, right? The median house price, those could just be bigger houses that are selling, and so we don't know. But if we get down to price per square foot, that really cuts out all the clutter, and we actually figure out what our house is worth. And we are pretty close. This data is a couple months old, so I'm pretty sure we're about at or beyond parity with the bubble.
What is that number?
Yeah.
Oh, so it's $92 or 90 it's $92, and then over here it's 90. So $92 a square foot. Again, this is median, right? So there's going to be stuff above and below. But you average it all out. And that's why it's a little choppy. And there's some seasonal aspect to this too, but it gives us a good feel for. You can see trends in outline there. Any questions about this at all?
I'm sorry, go ahead. A little speculation here. What about interest rates playing a role in prices?
Well, that's actually a good question. Interest rates do play a role in prices, right? They do. So if interest rates go up a percentage point, that's less, that payment for the same dollar of home is going to get, you're going to not be able to afford as much, right? And so, our interest rate environment has been very low forever, right? And it was even low before, even while prices were falling, it was low. But what's happened now is that we have a market that's stabilizing or is acclimated to the low interest rate environment. So what the trends you see here could be affected by an interest rate increase, definitely.
I think one of the major differences between 2008 and today's market is the investor involvement in the market. I remember in 2008, everybody was building spec homes. The guy who mowed my lawn was building a spec home,
Right.
and it was a very different market. Where it seems like today our market is driven by people who are actually moving into the homes, and it's not an investor-driven market. It seems to me.
Right. Well, supply and demand. We definitely overbuilt in 2008. I remember going to Midway to visit, and somebody was building this 5,000 square foot, 2-story home on the golf course, and construction stopped on it as the OSB board is going on the framing. They didn't get all of it on; they got some of it on, and then they walked away. There was a big pallet of sheetrock out in front of the home. It had been there for 2 winters. It was all bowed and rotting in a big pile, and the framing had rotted because it had been exposed to the elements for so long. So once the market corrected, somebody came over and scraped that. They just scraped a lot and started over again. But yeah, so you see a lot of distortions that occurred in that market where there's just this exuberant overbuilding and it's happening. So why are prices and sales increasing? Right, interest rates have been stable, right? They've been low, but they've been stable. So what's pushing prices up? Basically, it's economic fundamentals. Right, here's Weber County unemployment since 1990, and this will be inverse to the bubble we saw in prices, right? So you look, usually Weber County's got a 4% floor on unemployment. I mean, that's kind of been our historical, we touch that and flirt with it and we go up and down. Well, during the bubble, we shot way below that. We're down in the 2s, right? That was unnaturally low unemployment that was fueled by that boom. And then the correction was even worse as we shot up to 9% on unemployment. So that was devastating to the housing market because houses are based on what people can afford. And you'll see housing prices change relative to who's working, right? I mean, the housing market, you kind of take it as a big whole, right? It's like averages. I mean, for a guy who loses his job, he just lost 100% of his income, right? But if you've got 10% of your workforce out there, you still have 90% working. So the housing prices kind of, imitate that. They're not going to drop 100%, but they'll drop by degrees. So now, after our shock in unemployment, we've now worked back to our little 4% level, and we seem to be kind of chugging along sideways at that. So the question is, how long can this last, right? Where does unemployment go from here? Well, it's probably not going to get any lower. Probably not. But is it going to get any higher? I don't know. We may bubble along at this high level of employment for a while. But that kind of depends on really depends more on the national economy, because Utah is very diverse, and has a great workforce. So yeah, come on in, grab a seat. So, so finding the good deals in this market, how easy is it to find a good deal? Right, laying around. So first off, a good deal is all relative, right? So this chart indicates, this kind of shows you some relationships. This is not exact science, right? But the black line here shows you retail prices. This is a house that's ready to go. Someone wants to live in it. It's fixed up, right? This would be a house that you're probably living in, right? A retail price house. You want to move, you put it up for sale, you list it. The red line represents wholesale pricing. Right, these are houses that are beat up, scratch and dent, bank owned, distressed houses. They're going to be priced differently in the market than retail houses, right? So this spread is, we chase this spread. We call this equity, right? We're arbitraging here. So the relationship between those two prices changes depending on where we're at in the market cycle. So this is where we were back in 2011, 2012. Right there, you could find a big spread between retail property and wholesale property. A great time to flip houses if you were doing that. In 2006 and 7, we were right around here, right? You couldn't find good bargains. Everything was squeezed for the most part. But your retail pricing and your wholesale pricing were pretty close together. So the question is, where are we in today's market? Any ideas?
Feels like it's pretty close.
Yeah, that's what it feels to me. I think we're between phase 1 and phase 2 here. Phase 2 is where you start to see that spread, like there's a turn, right? Suddenly, now there's some opportunity out there. Something bad happened in the economy. There's some distress. Now, hey, there's some stuff to pick up at a value. I think we're somewhere between phase 1 and phase 2. Phase 1 is where there's just no spread at all. So I think we're right there, somewhere in that range. The good news is that this thing happens in cycles, right? So phase 3 here, where the spread is coming. It's your question of how soon. Okay, just to give you some examples, I pulled this off the MLS. I went back to 2012. Now take a look at the numbers on the very right-hand column there. There's your sold prices. These are split entry houses in Roy, built between 1970 and 1980. They're all about less than 2,500 square feet. 74,000, 90,000 for a 2,000 square foot home, 83,000 for 1,800 square feet. And then in the same neighborhoods, 140,000 for 1,700 square feet, 154, 152. So wholesale, top 3, retail, bottom 3. Right? You see, you can pick up a house for 83 and turn around and sell it for 150 if you get the price up to. Well, what does Roy's market look like today? What is the buying opportunity for wholesale properties in Roy? These are all 5 of the houses that are for sale in Roy. That are all between 1970 and 1980, split in same houses, right? And this is all that's for sale. And look at the price points there in your little listing column there.
Right now?
Right now, this is all that's available. If you're looking for bargains, this is what you're looking at.
Those are the only houses for sale in all of Roy.
No, that fit the criteria that I just described. So I took a split entry between 1970 and 1980 in Roy, and this is it. Yeah. So the price points have increased. We can see that we've got a very strong retail market. There's very little out there that's wholesale. So, how do you know if you buy a deal that's good? How do you know? You got to check. Your neighbor tells you, the realtor tells you it's a good deal. Always trust your realtor.
Maybe by the price per square foot would be a good indicator, depending
Right.
on how good a shape it's in.
You get a yardstick, right? You have some kind of yardstick that you choose. You measure the deal. So most investors, like the general rule is on a return on investment. If you're going to grow your wealth, you're going to want between 8 and 10% at least as a return on investment. And And this is on a cash flow basis, right? This is not a speculative investment. This is just saying, hey, look, this is for the long haul. This is what I'd like. So I'm going to give you an example of, this is actually, so this property actually just came back on the market last night. The buyer, this is one of my listings, this is the self-promotional part of the presentation. The buyer was out in Japan and was waiting, an expatriate, I guess, and was waiting on a bonus from his company. The bonus never came in, so they canceled the contract yesterday on us. But this is a triplex on 5th Street. Its gross income is, and I manage this property right now, so the gross income is about $1,728. Your taxes, insurance, and property management is about $705. So you subtract all that out, you get $1,023. Your mortgage on this thing would be about $553 a month with your regular down payment, which is just so incredibly low. So that puts you at a positive monthly cash flow of about $470, which is pretty potent. So it's listed at $151, right? You're gonna have to put $37.5 as a down payment. Your friction costs of closing are about $4,500. So take your $42,000 out of pocket. You're going to generate $56.40 in annual revenues for putting that money out, and so that comes out to about 13.5% return on investment. Right. So pretty good, pretty good. Here we have another example. I just pulled this off the MLS. This is another example of a listing that's out there. Any question? Okay. So this is a duplex, side-by-side duplex, 2,500 square feet, 1-bedroom units. So the math on that's kind of, I'm kind of wondering, there's some inefficiency going on here. There's some unused square footage. So its effective gross income is $846. Take out your expenses of $340. That leaves you $506, and your mortgage is $398, which gives you $180 a month. All right. So it's $99,000. So you put in a big down payment, and you're only going to get about $1,200 a year in revenue from that. So that puts your return on investment at 4.5%. And so this is a pretty lean deal, right? But this is similar to what I'm seeing in most of the marketplace right now. We're kind of in this zone of low yield, low investments. But there may be some opportunity here if you're thinking creatively, right? Because you've got the square footage, which is inefficiently used. If it's possible to put another bedroom in that apartment, you make it 2 bedrooms, you raise the rents. So your rents right now, I think, are like $425 for 1 bedroom. You put 2 bedrooms in and you dull it up a little bit, you can get $575 for 2 bedrooms. Suddenly your rate of return goes up because your cash flows are up, and it could be 11.5% under this scenario. Okay, so if you're looking, this is what the last example we used today, but if you're looking to fix and flip, there are some opportunities out there that you kind of have to be in the right place at the right time. This is a home that I listed back in April. It is a legal, non-conforming duplex, right? Cute little Victorian home. The owner, I sold this to the owner back 3 years ago, and we've tried to sell it, but it needs more work than the market's willing to put into it at our list price, right? So the owner is actually soliciting a capital partner, a joint venture in fixing the property. He'll contribute to the property. He's got a fairly low basis on the place, and there's some sort of opportunity here. So you got into the property at 90. Your post fix-up's worth about 150 because Victorian homes are in demand, and you don't find too many of them. The building's about 1,800 square feet, right next to the new D school, the building. So it's in a good location, up and coming, around the corner from my house. And your rehab costs are going to be about $40K. It's a big job, right? You're going to be doing some floor leveling and some new kitchens and baths, some plumbing, electrical, that sort of thing. Now the good thing about this is that the city is offering funds to folks to consolidate units, right? So if you have a multi-unit property that was once a house, the city wants them houses again. They don't want multiplex houses. So So the city will give you 20 grand to convert this back into a single family home. Well, back last session, I procured some funds for the city to do that. Yeah. So anyway, so the city got $750,000 from the state to put towards this unit reduction. So far, about 500 of that has been spoken for. So there's about 250 left.
Is the intent to bring more families to locate?
Well, yeah, so the whole purpose of this is to reduce the unsavory unit count in the city. And I mean, if you saw the upstairs of that unit, I mean, the rents on that prior were like $350, really low. And the tenant had painted the closet walls this like psychedelic tiger blue, like tiger stripes blue all over the closets. And definitely some recreational pharmaceuticals involved in the creation of that. Anyway, yeah, and the plumbing was, yeah, the house we kind of scabbed together year over year. The original casings are there, the original banisters are there. Just needs to be, the floor plan needs to be rearranged so that it makes sense. Susan, you have a question?
Yeah, the grant funds, are they, what stipulations, they
So-
actually give it to you?
Yeah, there are some rules. So the rule is that it has to be a multiplexed house, and you have to sell it to an owner occupant. Right? It has to go back to an owner occupant. You can't do it as a rental property after the reduction. It's got to go to an owner occupant. That's basically it. And they'll have a little worksheet that you'll fill out in the application that says, hey, look, we want to make sure that there's wherewithal to get this project completed. You know, that you've got, like, we're going to contribute our funds as a city, but you've got to have the funds to finish the job. We had one contract on this home where the buyer wanted to do the whole job just on what the city was offering, and the scope of the project was way bigger than that. And so he got into it, figured that out, and then he withdrew, so that created some issues for us. Hopefully that answers your question. Okay, so let's say that you find a property and you run the numbers. What do you do now? So the way that you purchase a property makes a difference. Now this is where I geek out on everybody. I got all the figures and put the charts together. You know, what if we could take all the different kinds of ways to buy a property, right? So you're going to get a conventional loan cash, you're going to live in an FHA, or you're going to get a seller finance. What if we took all those transactions, put all of them in different buckets, and then tracked the price points of those transactions over time to figure out how that affected the price, right? Because the way you buy a house can affect the price that you pay. So, for multi-units, right, so it's purely investment. This shows you the mix of the different kinds of ways to buy a house or buy an investment property over time. During the bubble, everything was conventional, right? They're throwing loans out the door. Banks were like, please, borrow our money. We don't care, just take it. Then the collapse happened. We see, the market went from 30% to 30, or 70% of the market to 30% of the market for loans, regular bank loans. That's a huge drop. Meanwhile, to fill the void, you see that dark line there, that's seller finance. Seller finance came in to be about 20% of the marketplace. It's a huge increase, right? Trying to bridge that gap, get buyers and sellers staring at each other, not knowing what to do. So anyway, interestingly now, cash came in to fill the void, but it still stayed at an elevated level. Cash is still a big part of the purchase mix right now. FHA is a huge part of the purchase mix, which is really interesting. And so conventional cash and seller finance, or excuse me, cash, conventional, and FHA are pretty much the entire market right now. And seller finance is kind of dabbling along the bottom. So here we are. Let's take conventional financing, right? So you see about 65, 68 bucks a square foot. Coming into 2011, it starts to decline and bottoms out in 2013. And now we can see the current surge we're in there. Prices are shooting up. Pretty significant price movement this last year.
Are these generally people that have a 20% down payment?
This is going to be 20 to 25% down payment. So it was going to be less before, right? So as you see your price points decline as those lending guidelines tighten. Okay, here's your cash. So same, you can see the comparison here, same chart, here's your cash. So you see in 2009, people were willing to still pay quite a bit in cash. There's some volatility there, but the floor dropped out after that and they bottomed out in 2020. Right? Pretty significant swing in price points, from 60 bucks a square foot to 30, right? Cutting prices in half when you're paying cash. And now we've seen it climb back up out of the hole, and we're still below our peak as far as cash purchases go. That's a little choppy where it's at right now. Okay, this is FHA, so if you're going to live in the house, right, you're willing to pay a little bit more than somebody who's not. Right? If you have little down payments, which FHA does, you're probably willing to pay a little bit more. So there's not much volatility here. It's kind of just hugs that little zone and slightly increases. And finally, we got this really choppy, squarish looking chart. This is seller financing. And you can kind of read, I couldn't find a good way to present this information other than this. So interpreting this, the squarishness comes because there are so few transactions, right? It might be a long time before another transaction occurs to give us another data point. So you get these weird jogs and exaggerations. But you can kind of see some trends in that. During the downturn, the lines are smoother because there are more transactions, right? But during the bubble, you'll notice that the price points in seller financing were really low. And that's because if you couldn't get a loan on it in 2007, it must have been a bad property, right? I mean, it had to have been really ugly. So the only way to do it would have been through seller financing, and that's why the price points were low. Yeah. So, questions, comments about any of this? I know your heads are full. All right. Okay, so just a quick recap of different ways to buy. So your conventional financing, 20 to 25% down right now. Right, it's credit driven. There's limits with certain lenders on how many properties you can actually finance. And you've got to have some savings in the bank. Usually some of the banks are wanting 6 months reserves on rents as a backstop to get you qualified for a loan. But the benefits are you get a stable loan, you know what you're getting. And because you have to put so much down, your debt service is low, so that reduces your risk. And that's helpful. Cash, you have a lot of money. Barrier. No money, no deal. One of the mistakes that cash buyers often make is they put all their money into the property and they just let it sit there. I mean, it's equity, and it's good, it's saving, but it could be working if you had some of it out there put into other properties, right? So there's a balance. There, 20 to 25% is usually that comfortable spot where you want to have equity in a home. And then the rest of it can be leverage working out there to grow well. Obviously, the benefits to cash is you're fast, right place, right time. Boom, let's make it deals, write it up, let's close next week. You can do that. And the prices, as we saw, are discounted. So your barriers to entry for FHA. I just found out from one of my lenders that there are grant programs now that can reduce this to zero down for first-time FHA home buyers. So it's a great way for them to get started getting into the market. It is credit driven, and they have to live in the property for 12 months, so there are some restrictions. But again, it's predictable, and it's a great way to get started if you're young, because you've got time to amortize that thing with a low down payment. Okay, that seller financing is my favorite way to do business when possible. I think I closed this year so far. I've closed 3 seller finance transactions. All my sales were those data points on the chart. Just kidding. So, your down payment, it just depends on the deal, right? If it's a great property, then maybe put a little bit more down and get some good terms. If it's really dumpy, you're not going to put a whole lot down and save your money and get it that way. Also, the big thing about seller finance, if there's an underlying note, people worry about the acceleration clause. And I could do a whole presentation on seller financing again some other time, but you don't have to worry about that unless you're in an environment where interest rates are higher than what your seller finance transaction rate is at. Prevailing interest rates bump up, and banks are going to be looking around for notice to call so they can get their higher interest rate on the books. But that's not where we're at right now. Yeah, it's not credit driven, low closing costs. You know, you're just paying for some title fees and quick closing. Okay, so you find a good deal, you know, portfolio of good deals. How do you keep it a good deal? Well, we're gonna have Josh come talk about some estate planning ideas. And Josh, why don't you come up here and introduce yourself?
So you probably all didn't know that an attorney was going to be here, otherwise you wouldn't have showed up. So I'm an attorney, and just a little bit of background. I used to have an office down the hall from Jeremy, which is how I met him. I just walked into his office one day and said hi, and we've done a few things back and forth.
I had a no soliciting sign up too. It was.
I just forgot that. So I used to work at a big firm down in Salt Lake, Curtin McConkie, and I opted out of the big firm life and I started my own firm a couple years ago up here, just off 25th Street. So a lot of reasons that I did that, but one of them was because I enjoyed working with families, smaller businesses, entrepreneurs, people who really care a lot about the bottom line at the end of their day. And so part of this, background that we talked about is going to involve that for families and investors because you don't usually buy real estate just to give Jeremy a chunk and feed his family. You're looking to feed your own families with your investments. And so we'll talk, just so you get an idea and you can start thinking of some questions. We're going to talk a little bit about some of the tax implications, kind of some of the ways you can protect your investments, and a little bit on the business side of it as well. So let's see here. Who here has ever heard of a will or a trust? Okay. What about a trust? Okay, there it is. That's good. So the basics as to why you're going to use a trust, especially if you're talking about real estate investments, is you don't want to use lawyers. That's really why you use trusts. And what I mean by that is if you pass away, or don't, with or without just a will, you're going to have to go through courts, you're going to have to use lawyers in order to make sure your family and the other people involved get what you intended to give them. Trusts are a way to get around that while you're still alive. It could be a vehicle to get around certain taxes and to protect it, depending on how it's set up. And this is not meant to be we're going to go through all the nuances of different trusts, but I'm happy to answer any questions that do come up. One of the big things that you're going to think about, though, as you're setting up wills and trusts, as you're investing in properties, is who actually owns that property. Now, a lot of times, depending on the financing options that Jeremy discussed, you may be personally the individual who gets the note. You may be personally liable for some conventional or the FHA initially because you have that financial background. Eventually, you're going to want to switch the ownership of this property either into a company like an LLC that you set up, or into the name of a trust that's going to be run by you in the same way that an LLC would be. Now, who has any properties inside of an LLC? Okay, who has properties just owned by the personal names? Okay, why would you have it owned by your personal name as opposed to an LLC? Any thoughts?
Laziness.
Well,
maybe.
Convenience,
Convenience.
not wanting to do 30 different tax returns for different LLCs.
Yeah, that's true. Because it can get expensive on the tax side if you have 30 properties and 30 tax returns as opposed to this is me and here's just another schedule to my personal taxes with some investment. You're right. What are the benefits of putting it into an LLC?
Asset protection.
Protection is the biggest one, especially if you're looking at an investment. The last lawyer you usually want to hear from is the one who said your tenant slipped on your property and here's my card. You hope you have good insurance, coverage on the property, but you really don't want to put your asset at risk. In fact, that's usually how big companies protect all their individual assets. Your airlines, for example, each plane is housed within its own corporate entity. So that if that one plane goes down, then it's not the entire company at risk, it's just that one individual asset and the cash flow going through it. You, on a smaller scale, you could do the same thing, where you can protect your company and that one property by having that. Now, does it make sense if your property is only 100 grand to have an LLC, separate for all 400 grand properties? Maybe not. That's more of a cost benefit to you as to when it makes sense to get a second or a third LLC. So you can layer it in whatever way you want. Some people layer it for privacy. I had a physician say, look, I don't want anybody to know that I own this company, or I don't want anybody to know that I own this property. And so they can layer it, it's ABC LLC, or a lot of times you'll see street addresses as the name of the LLC. So it's 60 25th Street LLC. I have no clue who owns that. It's usually an attorney that's the agent on it, and that's all you can see. And so there are lots of reasons why you do it. But the biggest one is to protect it. Protect that asset and your investment in it. Jeremy did mention sometimes in your financing you're going to get acceleration clauses on certain loans. Now, technically transferring the deed on a property into a trust may trigger that financing, but I've never seen any bank enforce it. As long as it's your personal trust, your personal company, your personal entity. Now, if you're transferring it to your brother's company, they might have problems with that. So you might feel them out and see what that relationship's like, but I've never seen a bank, and I don't know if you've heard of anybody enforcing it in that way. It's usually you can't transfer it to a third party, or else.
I have a question. You mentioned having an LLC for each individual, say, rental home. Is there a magic number of how much a person should hold in one LLC? I mean, is there like a top level that you can put yourself at bigger risk?
Well,
like a million,
usually,
like you make 500,000 in one LLC, should you have to then form another one?
I mean, that's probably a good, you could come up with that rule of thumb, but like from a legal perspective, don't have anything more in one LLC than you'd risk losing for any incident. So technically, if you have 5 properties at 100,000 apiece, you still have 5 times as likely chance that you're going to have a lawsuit under that LLC. Or you're going to have 5 times more tenants that could slip and fall under that umbrella. So there is that cost benefit where you're going to have to figure out, do I supplement this by getting higher coverage on my insurance? Or do I supplement it by switching out to a different LLC? I mean, LLCs are pretty simple to set up. The state filing fee is $70. You can do it online yourself. It's $15 a year to renew. And then a couple $100 tax return at the end of the year. That may be cheaper than getting a higher insurance policy. But those are great questions to think about. I think 500,000 is a good number to start evaluating switching it over. But you may be so risk averse that you don't want any multiples of claims, so you'd only want one property in each instance. That's where you're comfortable.
And maybe it's not so much the value of the property, but how much equity you have in it, right?
Right.
Because owing a lot of, owing $450,000 on a $500,000 property is kind of its own asset protection, right?
Yeah, I mean, you can look at it that you only have 50 grand in that property. So it might not make sense. So the other way that you might look at it is, what's the damage going to be if somebody does slip and fall on that property? So you could look at it from that perspective as well.
Well, you just described it wasn't very expensive to set it up, but how difficult is it to manage? If you have multiple LLCs, I guess that's a possibility. It's something you need to consider. If it requires a lot of tax work at the end of the year, or if it's all just be bunched together and be done all at one time.
Well, that's what I said, a couple $100. I mean, you can shop it around. If you're working with a realtor or a business or a state attorney, they can usually say, hey, here are the people that are going to, this is really simple, cut and dry, a couple $100, you're done. And they can take care of it. There are other places that will charge you $500 per LLC as a flat fee. So yeah, you have to be smart and shopping around accountants at the end of the year. But you're right, the management of the LLCs could be an additional cost to consider. So that's great. Yep.
I think it's important to do the LLC, that you keep your accounting separate from your personal accounting, because it can become extremely time consuming at the
not only that, in a lawsuit, if you're commingling funds, pretty much the attorney can say, look, this isn't, you're not operating this as a separate entity. You're mowing your own lawn with all the assets or whatever, and they can pretty much throw out the LLC and still attack your personal assets.
Unless there's a simple management process here, check these boxes and you're good, right?
Yeah, so I mean, all right, so I'll give you some self-promotion, and Jeremy did a little. A lot of times you'll have an attorney be your registered agent on your business. So, I do that for clients. And that usually means I'll get all the communications from the state, and I'll make sure I communicate with your accountant, give him or her the right information, and I just, say, hey, we got to renew this, it's $15. I'll send you an invoice for the $15, and then you pay it out of your business account. So that's a way that somebody else is kind of managing some of the structure, the day-to-day, and they only bring you into the loop for the decisions.
So is there like a management fee involved with that as well, others?
Yeah, we can talk about that. Yeah, but those are things you can think of too. I think it's smart. Keep it separate, because when you start, mingling things up, and hey, the top shelf is the business, and the bottom shelf is the family, and here's my recreational. The kid comes along and messes up all of your papers, like mine always do, and you could end up starting to mix things up on accident. The government's not going to care if you accidentally started mixing things up. They're just going to care if you really did mix things up. Start paying the wrong things with the wrong cards, and then you can not be as protected as you intended.
I was wondering if you've got some other experiences with it, because I've had slip and falls. Insurance has always taken care of it. Even unfortunately had a death at an assisted living facility. Insurance took care of it. I mean, I've never really had that big of an issue. So in my mind, I'm wondering, is it just the attorneys trying to make everybody paranoid so they can get a bunch of work? Or do people actually get sued over some of these slips and
they do,
beyond
they
the
get
insurance?
sued. I'd say it's going to depend on the kind of tenants that you have, and usually their socioeconomic background, and the difference between residential and commercial. If you get into multi-use, and by multi-tenant, 5+, you're going to get into more the commercial side of things. If you're on the duplex, triplex, fourplex, you probably won't see as much of that. And the other area is that sometimes property owners try to cut corners in costs, increasing their return by not having sufficient insurance. So if that doesn't apply to you, and you always make sure you have really good insurance coverages, then an LLC might not make sense for you, except for the privacy side of it that you might want. But yeah, if you have the right insurance is going to cover your liability in the same way an LLC would. So there may be other reasons to have it or not.
In what case would it exceed the insurance? What case would it appear?
Well, I guess it depends on the insurance that you have. Sometimes your loans require you to have like $1 million, $2 million policy. You're probably going to be fine with that. Unless there was some serious gross negligence that they're saying, hey, you got a pothole here. My sister came to my party. She fell and she died. And it became this horrible thing. Or the worst case scenarios, just morbidly, is when a child's involved because they have a longer life. There are bigger claims involved and bigger damages. And to the extent that you have some more direct action involved, and not just I should have but I didn't, then those rates can go up. That's not really anything we planned for, but that's when those things could start getting to those limits.
Yeah, it seems like if you have property worth $250,000, your insurance is required to be $500, but your total assets are well into the millions. Then if you don't have an LLC, your whole assets are at risk, I'd imagine. So the larger your total net worth, the more an LLC would make sense.
If you personally own a home, it's covered at $500, and let's say the claim is at $750. That difference of the $250 that your insurance won't pay out, if it's personally owned by you, it's coming up to your bottom dollar. You're going to have to make up the difference. If it's under an LLC, the LLC goes bankrupt technically.
That's sorry to a lawyer, in that way, understanding, I guess, or at least a perception I have, which may or may not be true, is that if there's money, attorneys are gonna go after it and keep going after it, and they're getting potentially paid. So you're at higher risk of losing additional assets.
Oh yeah, all of that. I don't
if you
know
have
if
more of
lawyers
it.
provide- Yeah, lawyers usually take 40% of those types of claims. They're on contingency, is what it's called. We've all seen commercials with them, so there are plenty of them out there. So that's just a reality we deal with as an investor in a property. So you're not going to get rid of the attorneys, you're not going to get rid of the people that make those claims. Those are just the things you balance as you're going through all this stuff. Some of the other things to think about, if it's not the attorneys, it's the IRS. So these two sections are big ones that you deal with or could be thinking about. So section 121 of the tax code and section 1031. So 1031 allows for exchanges, but there are certain rules to them. They have to be very similar type of investments. And do you do 1031 exchanges very often, or Jeremy?
Not too often. I had recently. I have. But,
okay, so 1031. So these. Okay, let me back up. These only matter when you start wanting to sell your properties. So if you're looking for just long-term cash flow, you probably don't have to worry about this that much. But if you want to sell it out and now get that equity out of it, and either reinvest it or just put it in the bank, these are the things you start thinking of. 1031s are involved with if you're going to swap, let's say, one triplex to another triplex. Now that's oversimplified, but basically those are pretty similar properties. And any gain that you get on the sale of your first one, you can invest into the second one, tax deferred. So the IRS is not going to tax it when you sell it as long as you invest it in a similar qualifying property. So that's one way of not paying taxes right now, maybe being able to upgrade or get a new property. Section 121 applies to the owner occupants, where you can get tax-free gains up to $250,000 for single, $500,000 for married couples if you've lived in the home personally for 2 of the last 5 years prior to the sale. So I told my wife, when we start buying houses, we're just going to go and live in a home for 2 years and then sell it, and then go and live in a home for 2 years and sell it. And, like we would have invested 10 or 20 years before, but that's our retirement. We're just going to spend a couple years in different places and sell it out. That's my way of getting around having to pay taxes on homes, but she told me no. We'll see, maybe one day. But that's one way you can think of doing it as well, to the extent that it comes up. Those are some others. The other issues are estate taxes. Now, some states have estate taxes, like California. No surprise there. Utah does not. And then the only thing you're going to have to worry about, as long as you stay in Utah, and as long as Utahns don't change that law, is that $5.4 million is the federal estate limit. So as long as your estate and your holdings are under $5.4 million, then you won't have to worry about federal taxes either. So it's a little bit of tax-free possibilities. But if you start getting to that point, then where you're on the fence, maybe you're going to go over that threshold, then you may start thinking about liquidating assets or putting in certain trusts that allow you to sell assets, and instead of paying taxes, you can donate certain things to charities and put it into a trust where you can get an annuity on it. You'll still get that cash flow, but you won't pay the taxes. And you give the benefit of that sale to a charity. So it's kind of a win-win and an anti-insanity. So you can set it up in fun ways, depending on what your interests and priorities are. But those are things you're going to have to obviously think about in advance. You're not going to be able to do it after you've sold it, after you've closed it. And that's going to really come up if an LLC is owning those properties. You couldn't get some of those benefits if it's just your personal name on the home. It's just going to look like a person selling the home. Let's see here. Oh, cash flow tax perspective. So on this area, you're going to get capital gains versus ordinary income. So who's ever heard of those two different phrases out there? So capital gains, what's that kind of a tax at these days? Ever heard of capital?
When you buy something, you sell for an increase, and the difference is capital
Are you taxed higher or lower than ordinary income?
Lower. Okay.
Lower. So ordinary income right now maxes out at almost 40%. So if you make a lot of money, they're going to take 40%. Most of us are probably down in that 15 to 25, 30% range. You want to make more, but there's just that reality. The more you make, the more you take. So capital gains does cap out at a lower amount. So if you can get certain income on capital gains, then that's going to be obviously better for you. The way that you can manage some of that, and I made a note of it in the beginning, you were talking about investing in your properties a little bit more as a capital improvement. One of those ways that you can decrease the overall taxes you're going to have to pay when you sell it is by making those investments over time. So you can take a little bit, you can invest in your property, that'll increase what you've paid, it's called your basis. And then at the end when you sell it, there's a smaller amount that they'd be able to take even of your capital gains. So those are two different ways of thinking. Cash flow coming into you is going to be taxed as ordinary. Selling your property, that big chunk is your capital gains. So there are strategic ways you can think about this, and these are good things to talk with your realtor about, with Jeremy, especially because, well, I don't know if you guys have used other realtors, but I'll tell you, he understands numbers a lot better than most realtors I've worked with. So he can sit down and talk hypothetically with these numbers, and he really loves them because you saw from the charts. He loves these numbers. So he'll sit down and walk you through them. We've already kind of talked about the differences in the liabilities that are out there. One of the other big things sometimes comes up, I don't know, has anybody ever pooled money, family, friends, to invest in a property? Or thought about it?
We'll admit it.
Yes, it says that bad. Unfortunately, when you start pooling money, you start triggering certain SEC reporting requirements. That doesn't mean that you're going to jail. It just means you usually just have to disclose certain things. As long as the numbers of investors are few or they have lots of money behind them, you don't have to go and register on the NASDAQ and like publicly traded stocks or anything like that. But you need to disclose it, and also to the state of Utah. So if you start thinking about that, just be aware that there are rules out there to follow. A lot of real estate investors that I work with as an attorney tell me everybody does it this way and nobody reports it, so it's got to be fine. And I'm like, I hope you don't get a call from the SEC because technically it's not fine. I'm glad you've never been caught. I'm glad none of your family members have ever been, approached. But those are the rules out there. So ways to get around it is to have people actively involved in running and managing the business. But if you just have people that are collecting checks as a percentage of the cash flow, that's where you fall into trouble. And then we're not gonna, we've already talked about asset protections. And let's see here, I'll just give you a couple of these war stories. We've already kind of mentioned LLCs, so I won't worry about it. Operating agreements are a function of LLCs. It's basically the rules for how the owners in the company are going to fight. And the laws in Utah have been changed over the last few years for LLCs, so that effective in January of this next year, your authority to do anything with that LLC is going to be based on you having an operating agreement. So if you don't have one, you need to get one. Googling them might be successful. You might find a template that would work. But I'm happy to share with you some ideas on that process as well. Usually, when multiple owners are involved, that's when the disputes happen. And then, of course, when the money starts flowing in, that's when the other disputes happen. And to give you an idea of what it costs when disputes happen, it usually is $10,000 to $20,000 just to settle ordinary lawsuits. And by settle, I mean getting attorneys involved and going to court and getting an order. And that's way too much. By the numbers that Jeremy was showing, you had a $5,000 return in a year on one of those properties. So that means if you don't have a $500 document, which is what a normal attorney might charge you to do it, then you've just forfeited 4 years of income to that property to settle a dispute on that property. It just doesn't make sense, but people do it. So if you have questions, we can talk about trust. You've all heard the stories. They go to courts. that get fought about for a long time, especially when property is involved. The last one is more of just a reflective question for each of us. Is if somebody came to you and said, you have 2 weeks left to live, what are some of the things you want to do with the last 2 weeks?
Skydiving.
Skydiving? What do you guys think? Spend with family? Would spending with your realtor be on that list? Spending with
It'd be online.
be on that list.
That's part
Spending it with your attorney is probably not on that list either. Sad story. So there's an 85-year-old client of mine, and he was diagnosed with a disease, and he had put off putting all this stuff together, all these investments he had for his kids. So unfortunately, his last 2 weeks that he had of life, he spent the majority of it with me, and I wish that he had. He was glad that everything was sorted out, so his kids didn't have to fight about it and worry about it after he passed. But that's what he spent his last 2 weeks doing. So I'd encourage all of you. It doesn't matter whether you're 25 or 85. If you don't have something, put something in place. If you have somebody that's done it for you, check up on it. Every 5 years, or if there's a birth, death, or marriage in the family, those are kind of the times you need to make sure everything's put in place the right way. So you can go skydiving. So you can go and hang out those last couple of weeks, and you don't have to worry about whether your investments are going to be preserved the way that you have spent so much of your time putting together. And the other thing to think about, I didn't have a cool chart for this, but with the market turn, actually, lawyers and law firms were forced to realize that you can't just charge exorbitant rates and expect people to make money from thin air. And there had to be dynamic models. So, one of the approaches I've done, and I've known other attorneys that have done it, is they have more of a flat fee model, where an investor and a business owner can come and say, I need X, Y, and Z, and they can say, all right, here's your quote. And not this ambiguous hourly, well, here's my hourly rate, and I don't know how long it's going to take until you get this bill in the mail, and it's much higher than you were anticipating. So just know that you, as a member in that community, as a consumer of those kinds of services, you can find very competitive rates out there. You can find things that match your needs. And I'm happy to give referrals, so there's no one size fits all. So if I'm not the right fit, I'll give you a few names for people that would. So anyway, thanks.
All right, well, thank you, Josh. We'll wrap up our meeting by just talking about what are some of the best strategies for investing right now. So let's go back to our wholesale versus retail scenario, right? So currently, we're somewhere in phase 1 and 2. The market's running up. It's still running up. It hasn't shown any signs of slowing down yet, but we know that it will eventually, sometime in the future, slow down. Right now, shuffling is a good strategy, right? If you've got property that is sort of dead weight in your portfolio, it's kind of a problem property, maybe you got a loan on it that's too high of an interest rate and you can't refinance. I'm in that boat where underwriting guidelines changed from 2007, where I could get into a property with basically nothing down. Now they require 25% equity or more to refinance. I still haven't paid down the mortgage enough to refinance, and I've got like a 7.6% rate that I'm paying, right? So my cash flow is not as high as it could be if I sold it to somebody else at the same price and maybe have better cash flow. So anyway, I happen to like this property, I'll keep it, but
So how long do you expect the window for selling property to be open?
that's a
What's
good
the
question.
crystal ball?
My crystal ball. So that's right. So 12 months ago, I was saying that we were at the top and something was going to happen to plateau us out on pricing. I don't think prices are going to decline. I think they're going to flatten out. And then I think that with the flatness, there will be buying opportunities below that, the wholesale pricing below that plateau that you can get into. I think rents will continue to increase a little bit during this next period. But as far as timing goes, I thought we were done a year ago. And sure, I'll have to go back and I can kind of show you some thoughts on some of the old. I can go back and maybe look at some of the charts and show those to you. But basically, if you look at the sales activity, a year ago, sales activity, the trend line was sideways, right? Which told me that, hey, we're stabilizing, we're reaching this point, and then right after that year of stabilization, it went whoop, and started accelerating again. And so that was a bit of a surprise. Part of that has to do with how energetic and dynamic our local economy is, right? I mean, we are the best, one of the best economies. I mean, we don't know it because we're living in it every day, but we are one of the best economies in the U.S. right now. Our unemployment rates are so low. You go elsewhere and they're 1 to 2 points higher at least. And so but we're just, we see it every day. It's just what we're used to, and I don't think we fully appreciate that. But so what I see happening is that there will be some sort of economic shift. Something will happen. It could be China slowing down. It could be something that causes a global, and it's going to be a global thing, right? But if there will be a slowdown in the economy, there will need to be an adjustment period. And that adjustment period will result in some layoffs and job losses. So we'll see that unemployment number, that chart will start to move up again. House prices will moderate. If we have a skyrocketing unemployment rate, like we saw that big climb up the hill there, then we will see house prices drop significantly. But if it's just a point or two increase in unemployment as things adjust, you'll see it'll be more like a 2000 to 2004 housing recession, where house prices plateaued out, but there's a lot of wholesale buying opportunity below the price points.
How do those things affect rent?
So rents tend to be pretty sticky. Rents tend to be pretty sticky because what happens is what happens is you get a shift in ownership, right? So people that own homes, that lose their jobs, suddenly they become renters, right? So this is another thing that's happening right now is that my tenant quality, so I manage 45 units right now, our tenant quality is probably the lowest that I've seen it. And it's not for us screening. We were probably the most stingy of property management companies when it comes to screening tenants. I mean, we're doing genealogical research and blood type tenants, right? And right now, because so much of the buying pool, or so much of the renter pool is buying, like I'm actually selling homes to my tenants in my properties because they come in for a few months and they're like, I don't want to buy. I'm like, okay, great, you qualify. So then I have to replace them with somebody who can't buy a house, and that's usually not as desirable a quality of tenant. So that's the flip side of it, is that tenant quality is lower than it has been historically. If the recession hits, we'll see tenant quality improve, and rents are pretty stable.
Just an observation that I saw through the downturn, we saw this incredible crash of home values, but I never adjusted any of my rents through that downturn. We didn't see a decrease in rents, mainly because the rental pool was kind of flooded and there was more competition, and sometimes you're able to raise rents in those scenarios. I'd like to see a chart of, a plotted chart of rents. I don't know what historically they look like, but
that's difficult information to get. We have to go to federal data or some BLS data.
Yeah, that'd be interesting.
And in Ogden right now, is there an over-availability of rental properties? So it's a good place to be at to have rental properties. There's plenty of people looking and not an overabundance of places.
Right. So Ogden, actually, we have the ignominious distinction of having the most rental units of by number of any city in the state. Beating out West Valley City. So Ogden has 85,000 people in our population. West Valley City has 125,000, and we have more rental units by number here in West Valley So it's an interesting question to ask. Our vacancy rate is around 4 to 5% though, for properly managed properties. You know, the scratch and dents, the boogers, you know, the occupancy is lower on those than it is on tenable properties. But yeah, there's enough warm bodies, you know, people in the marketplace to fill this space here. There was a period when Ogden's population was declining. So back from 1970 to 1990, maybe even 1960. So for a 30-year period, Ogden's population was decreasing. And with that was catastrophic to the housing market here. That's when you had all these abandoned properties, vacant properties, tons of deferred maintenance on the ones that were occupied, and it really kind of gutted the housing stock here during that period. So since that time, we've been improving and increasing, and now the population's improved, we've surpassed its peak, and so there's enough people here to fill the home. So vacancy rate, ambient vacancy rate is about 4 to 5% right now for properly managed property. So another strategy right now is wealth conversion, right? Taking wealth from one asset, stocks or bonds, or some other risky asset, and then putting that in, you know, or taking cash out of your mattress and putting that in real estate to preserve it, right? Because even if we go into a buyer's market, the housing market still isn't that volatile, right? I mean, you might lose 5% for a couple of years, or 10% for a couple of years, or during the camel hump period there, we lost 15%. We were counting 15%. You know, the other markets during that same period were much more volatile. So if you're looking to preserve wealth, this is a good strategy. Sometimes your options are not great in growing the wealth, right? You're not going to find all the 15-20% return on investment properties doing this strategy because there's some limits to what you can invest in and how fast you have to invest in it. But it is a lose less now strategy and preserve things for the long haul and get you some cash flow. So, you know, the big thing is get started, find the best deals, and if you aren't already, but I'm looking at this room here, and if I can take the collective experience of everybody in this room, I mean, we're get over 100 years of real estate investment experience, and not just with these two guys. But you know, we've got a lot of experience in this room, so this is more for the newbies. But so you guys have been good about asking questions. What other questions do you have about any of the information presented tonight? Anything on your mind or you want to discuss? Yeah, well, pretty much.
Question. What do you see in as far as value is gain on property buying rental houses versus raw land and that appreciate?
So the best value in a property is a property that's improved, right? Because that's what draws use. There's more utility in an improved property. Raw land is somewhat speculative, and the value curve on land, it's more volatile than an improved property. Because land, like during the bubble, land was at a premium. And people were paying $100,000 an acre for farmland to build houses on it. And then when the bubble collapsed, you couldn't give the land away. I mean, nobody wanted the land because it was a liability. Because you had to pay taxes on it. If you weren't going to build a house on it within that year, why would you own it? Right? You know, you didn't want to put alfalfa on it. So land prices dropped. I mean, they went from like 100,000 an acre to like 20. It was a huge drop. I had a little story. One of my colleagues back in 2007, he had purchased a bunch of rental properties in Ogden during the recession 2000 and 2004. So he bought in 2002 the trough. He bought 50 properties. And so he was set. He bought them all at half price. You know, he had cash flow. He was set. And then the bubble happened. And suddenly his rental properties were worth 2.5 times what he paid for them. And he's like, well, I can take that money and then, buy more properties with it because you can pull the equity out of it through loans. So he leveraged his entire portfolio, and he took the cash, the loan, the loan money, and he put it as a down payment on land in Oregon in June of 2007. So it was a down payment. All that leverage went as a down payment to a giant tract of land in Oregon. And he took it, some of that money and built $1 million spec home in Pleasantville. And he built a commercial building in North Ogden. So he took all that in March, April, May, June of 2007 and placed it as the next bet on the leveraging to grow all those assets. Well, you can imagine what happened to his land value shortly thereafter, right? He got wiped out. He got wiped out. The entire portfolio of rentals that he had leveraged up to 100% or more got cleaned out. So they all went through the foreclosure cycle and the debt was reset on those homes. So land values, if you're going to grow something on it, if it's got utility, that's great. It's an insurance policy, you got food, right? But if it's speculative, I'd be careful with that.
Well, one more step, is it good to develop raw land right now?
Right now the market likes developing. Yeah, that's
building lots.
Yeah, that's kind of that's a place where money can be made. Is building a spec home, or pre-selling the lots and saying, hey, look, we're going to build you a house. You're going to become a little home builder. The market rewards that right now. And particularly if you own land, your basis is very low and there's some profit there that you can.
So it sounds like, but you did say we were going to see a leveling off.
That's my
view. So we don't see, no one really has said there's a bubble, there's going to be a sharp decrease, there's no factors that would really account for a big drop like what everyone thought would happen leading up to 2008.
Right, so and we have to understand the reasons for the collapse, right? The reasons for the collapse. The house prices were based on loans being issued. The loans were based on payments calculated to be less than interest on the loan, or interest only on the loan. And also with the fact that the buyers that were receiving credit could never afford, like some of them didn't have jobs, right? So there was no economic basis following just fundamental laws of economics, right, to justify issuing that loan. But yet those loans were being issued, like hand over fist. And so all those people in the marketplace with loans were competing with each other to bid up the prices of those properties. And so when that plug was pulled on the financing problem, that reset collapsed those prices. And so now we're back to fundamentals, right? People can afford, real people with real jobs, with down payments, with good credit, can afford these homes. And now the prices have come back. So that's what I'm saying. At some point, the market will plateau out because people will be tapped out. Incomes will stop rising. If incomes continue to rise, we will continue to see house prices increase because they're tightly correlated. And we're seeing wage growth right now with unemployment decreasing and productivity. We're seeing wage growth, but at some point it will plateau out. It has to. So
would it be safer to move in the scenario where this person lost all his assets? Would it be a safer move to take some money out of a home and leverage some properties, or what do you do with your money? It didn't sound like there was any really good investments right now.
That's the good news is that there's no news. It's kind of a conundrum. That's where it's like I'm looking at my accounts, kind of doing some housekeeping. Okay, can I improve rents here? Can I do some capital improvements into a property? What can I do to increase my returns, increase my portfolio? The wealth growth opportunities are very slim. So You know, sometimes a good strategy, if it's not broken, don't fix it, right? The opportunities to grow the wealth often come very quickly, and if you're prepared for it, you can take advantage of it. I mean, I wish I had resources that I could have used back in 2011. Right, across the street from me, there's a house, there's a triplex, a 3,000 square foot triplex. It sold for $35,000, so $10 a square foot, 2010, right? I was jumping up and down like, hey, somebody, let's go buy this thing, and no one would touch it, because everyone's like, I don't got any money. I'm not ready. You know, no one was prepared. And that was why the market was so extremely low. And that property sold to the owner, current owner, for $190,000 after the guys dumped about $30,000 property.
You should still, with the properties that you use as rentals, do you still recommend that you have, they're not paid off completely, that you maybe have a 20%, 30,
right,
25% of margin, I guess.
So if you follow like REITs, right, real estate investment trusts, their model typically, and keep in mind that they have huge portfolios, right? That they don't want to get more than about 80% or 80% loan to value, or they don't want more than 20% equity in any property. If they get more than that, they'll refinance and pull that money in and reinvest it into another property. Because at 20% equity, the debt service is manageable, and it's about cash flows, right? You're getting a good return on your investment. And remember, the more leverage you use, the greater the return. But that 20% sort of that sweet spot balancing the risk and the return. If you want to aggressively grow your debt, or excuse me, if you want to grow your debt, zero down, right? If you want to grow your wealth, 10% down is a marginally safe place to be, because you don't want to walk away from that 10%. Usually a lot of our seller financing transactions are done at 10% down. That covers friction costs, gives the seller some money in their pocket, and the buyer, that's still enough skin in the game that the buyer doesn't want to walk away from that. Right? They're still in the game. They're going to make sure that they make the payment and keep the property going. If you start getting lower down payments, and suddenly there's less skin in the game for the buyer, and the risk goes up for the seller or the parties involved there. But right now, you want to make sure that if you have low down payments, there's still cash flow, right? Because the cash flow hedges your risk of disaster, right? If you leverage, go zero down, and your rents don't even cover the mortgage, you're going to be in big trouble. You're going to be feeding that thing every month. If you hit some hard times, the first thing you're going to abandon is that alligator that's eating at your wallet, right? So, any other questions? All right, well, thank you guys for coming tonight. Appreciate your attentiveness and good questions that you guys asked tonight. So, if you guys have any other issues related to real estate or estate planning, just contact Josh and I, and we'll be putting on another one of these probably in January. We'll be covering some different topics, try to mix it up. But I figure this is a good format for everyone to get together, and if you've got some feedback on what you want to hear, or if you want some opportunities to hear about some different things, let me know. We'll put together some information and make sure you guys are fed and informed. So anyway, thanks you guys for coming.